For decades, professional investors charged high fees promising to beat the market. Many of them tried hard. Most of them, over long periods, did not succeed. Then a quiet idea changed everything for ordinary investors. Instead of trying to beat the market, what if you simply owned the whole market at the lowest possible cost? That idea became the index fund, one of the most important inventions in modern personal finance. At its core, an index fund is a basket of investments that simply tries to match the performance of a defined group of companies, called an index. Instead of paying experts to actively pick winners and losers, the fund mechanically holds the same companies as the index, in similar proportions. There is no fancy strategy. Just steady, transparent ownership of a wide piece of the market. This matters because the absence of fancy management usually means lower costs. Less research, fewer trades, fewer experts to pay. That cost saving directly improves your long-term returns. In investing, fees compound the same way that gains compound. Reducing fees may sound small at first, but across many years, low-cost index funds can quietly outperform many actively managed funds that try to beat the market. To understand how it really works, picture an index as a list. The list might include many large companies in a country or even across the world. The index fund simply tries to mirror that list. If a company is added to the index, the fund adds it. If a company is removed, the fund removes it. There is no guessing. The fund follows the list, calmly and mechanically. Let us look at a simple example. Imagine an index that contains 500 large companies in a country. Some are technology firms, some are banks, some are health businesses, some are consumer brands. An index fund tracking it owns small slices of all 500 at once. When you buy a single share of the fund, you instantly become a tiny owner of all 500 companies, in proportion to their size. A common mistake beginners make is assuming an index fund is too simple to be effective. Effective investing is often quiet and simple. The complicated approach feels exciting but often costs more and delivers less. Owning a broad index is not impressive at dinner parties. But over decades, the boring, low-cost basket has historically held its own against many more complicated strategies for the average investor. There is also a hidden risk in chasing actively managed funds purely because of strong recent performance. Past performance is not a reliable predictor. A fund manager who did very well in the last few years may simply have been lucky or favored by the recent environment. The next few years may be very different. Index funds avoid this problem by not betting on any individual manager's continued performance. A useful way to picture an index fund is as a snapshot of the entire market in one purchase. Instead of choosing a single house in a city, you buy a tiny share of every house in every street. If the city overall thrives, your investment thrives. You no longer need to predict which street will become the best. You ride the whole city. That is the spirit of broad index investing. A second key idea is diversification at extremely low cost. Holding a single company is risky. That company might struggle, fall behind, or fail entirely. Holding hundreds at once spreads the risk. Even if some fail, others succeed. The result is smoother growth over time. The wonderful thing about an index fund is that this kind of broad diversification used to require a lot of money. Now a small amount can do it. A practical example helps. Imagine two investors with the same modest monthly amount to put into the market. One picks individual companies, hoping to find the next big winner. They get a few right and a few badly wrong. The other simply buys an index fund every month. After many years, the steady index investor often ends up with stronger results, simply by avoiding big losses and capturing broad growth. Beginners often misunderstand that not all index funds are the same. Some track only one country's largest companies. Some track many countries. Some track only certain sectors, like technology or energy. Some track bonds instead of stocks. The structure can be similar, but what is inside the basket matters a great deal. Choosing the right kind of index for your goals is more important than the brand of the fund. There is also a psychology angle. Owning an index fund can feel underwhelming compared to chasing exciting stories. There is no story about a brilliant manager. No big calls. No dramatic predictions. Some people quietly drift away from indexing because it feels too plain. But this same plainness is exactly why it works so well over decades. The boredom is the feature. It quietly protects you from your own emotions. A simple practical rule helps you choose well. Look at 3 things. First, what does the fund actually track? Second, what is the total annual fee? Third, how broad is the diversification inside it? A fund that tracks many companies across many sectors at a very low fee is usually a strong starting point for most beginner investors. Anything more complicated should justify itself with a clear, understandable reason. There are things to avoid. Do not buy an index fund just because it had a great recent year, as no single year predicts the next. Do not pay a high fee for what is essentially the same broad market. Do not jump between funds chasing small differences. Do not borrow to invest more in any single index. And do not stop contributing just because the market is having a rough period. A better habit is to set up automatic monthly contributions into a small set of broad, low-cost index funds. Then leave them alone for years. Review your overall allocation once a year. Rebalance gently when needed. Resist the urge to make changes based on headlines. Most long-term wealth in indexing comes from the simple act of repeatedly buying and waiting, not from frequent adjustments or clever moves. Over the long term, index funds have quietly democratized investing. They allow ordinary people, even with small amounts, to own pieces of major businesses around the world. They have lowered costs across the entire industry. They have made it easier to build wealth without needing special knowledge or insider access. They are not perfect. No investment is. But they have made simple, patient investing genuinely available to almost everyone. So here is the short version. An index fund tracks a defined list of companies and tries to match its performance. It usually has very low fees because there is no active stock picking. It offers broad diversification at low cost. It removes the need to predict winners. It rewards patience and consistency. It is plain by design. And in many cases, that simplicity is exactly what makes it powerful over many years. If you want to invest in a calm, simple, long-term way, index funds are one of the most accessible tools you have. Pick a broad, low-cost option. Automate monthly contributions. Stay invested through ups and downs. Resist the urge to chase exciting stories. The boring path is often the strongest. Over decades, this quiet habit can quietly turn modest savings into one of the most reliable engines of long-term wealth.